It's inflation day for the markets. Here's what you need to know before the bell. So it's inflation day today, and expectations are for a fairly sharp drop in inflation from 4.9% year over year to 4% year over year this morning. Of course, that should have an impact on the Fed. This has been the hope of the markets over the last couple of days. In fact, markets rallying fairly sharply yesterday in anticipation of this weaker number, which in theory, this weaker number should put the Fed on permanent pause. No more rate hikes. That's been the hope by the markets all along. And since they're going to pause on rate hikes, that means we're now closer to a rate cut than another hike. And so this has really got the markets excited. Importantly, though, in the short term, markets are now well into that 3 standard deviation move above the 50-day moving average. We're more than 10% above the 200-day moving average. These types of extensions make it very difficult for markets to continue to move higher. Doesn't mean they can't. It does make it difficult, though, and this morning a much weaker than expected print on CPI could lead to a further advance in the market, further pushing this deviation near term. But odds are we're going to get a correction here sooner or later, so be careful chasing markets here. Actually look to use rallies at this point to reduce equity risk here a bit. Look for a pullback to add more exposure to your portfolio. There's two things to take away from what's happening with the markets right now. First of all, the market is trading with the 50-day now above the 200-day moving average. This changed the dynamic from a bear market to a bull market. So we are now clearly back into a bull market. The market is also trading well above the 200-day moving average. That is also a very bullish sign for the markets. Unfortunately, right now, I shouldn't say unfortunately, just part of what it is, the markets are getting fairly extended. If we take a look at our MACD indicator, which has been a really good indicator to buy or sell markets over the last couple of years, we're now back to a pretty elevated level that has previously been associated with at least short-term tops in the markets. Our money flow indicators also becoming very elevated as well. Again, both of these suggest that likely upside is limited, at least in the short term. So look for a correction at this point that is going to allow you a better opportunity to add some exposure to your portfolios. Importantly, though, corrections now are no longer going to be expecting 20, 25% corrections. Corrections are now going to be well confined to probably 5 to 10% overall. Look for pullbacks to the 50 or the 200-day moving average. Those are going to be your best opportunities to add exposure to your portfolio if that happens. So again, pullbacks here, we're now back to buying dips, at least at this point, until something else changes. But the bullish trend of the market has clearly been intact since the October lows. And of course, this recent push to new highs is well within that channel. So keep in mind here that this bullish trend channel is intact. Using pullbacks towards those support levels are going to be good opportunities to increase exposure. Be careful chasing markets right here because they are very overbought, but don't be afraid to buy on pullbacks. I'm your host, Lance Roberts, and that's what you need to know before the bell.